At 2:47 a.m. Eastern on December 31st, 2025, something unprecedented detonated across global silver markets. COMEX March futures gapped 11% in 40 seconds, jumping from $72.10 to $80.05, while Shanghai physical silver printed at $88.40, an 8.35 premium that shouldn't exist. Dealer inventories that showed 2,400 one-ounce bars at midnight now displayed out of stock, no ETA. Across every major bullion site from APMEX to JM Bullion, the spread between paper and physical, a divergence that typically measures pennies, had blown out to levels not seen since the Hunt brothers' collapse of 1980. This wasn't a rally. This was a liquidity vacuum forming in real time, the moment when decades of paper derivatives met the immovable reality of physical scarcity. And it was spreading. By 3 a.m., registered COMEX inventory had dropped another 3.2 million ounces as delivery demands overwhelmed the system. The alert came through trading terminals as a single red bar. Violent, unexplained, systemic. By 2:51 a.m. Eastern, silver lease rates in London had spiked from 8% to 24% annualized, the kind of borrowing cost that signals someone, somewhere, desperately needs metal they can't find. The COMEX March contract was now trading at $80 with bids stacking up and no sellers appearing. The Shanghai Gold Exchange showed chaos in reverse, physical silver quoted at $88.40 per ounce, $8 above COMEX futures. Under normal conditions, traders buy cheap in New York, sell expensive in Shanghai, and pocket the difference. When that spread reaches $8 and nobody's arbitraging it, it means one of two things. Either COMEX can't deliver or Shanghai won't sell. Based on what happened next, it was both. COMEX registered inventory stood at 127.6 million ounces at midnight. By 3:15 a.m., it had dropped to 124.4 million. 3 million ounces had vanished in under an hour. Open interest represented 1.12 billion ounces of paper claims. The math, paper exposure was now 9-1 against registered physical. Any pretense that this was a balanced market had just evaporated. By 3:05 a.m. Eastern, the liquidity panic was documented across every dealer platform. APMEX, which typically maintained 15,000 plus 1-ounce silver eagles, showed 0. JM Bullion, 0. SD Bullion, 0. Provident Metals displayed a banner. All 1-Oz products temporarily unavailable due to unprecedented demand. The timestamp, 2:53 a.m. Premiums told the story. 1-ounce silver eagles, which typically traded at 3.4 over spot, were now quoted at 15 to 18 over spot. When you're paying $95 for something the screen says costs $80, you're not buying silver, you're buying proof of delivery. The paper price had become irrelevant. Delivery timeframes collapsed. Monday night, standard shipping ran 3 to 5 business days. By 3:10 a.m., dealer sites showed 10 14-day windows. Some added, delivery timing cannot be guaranteed. Translation, we'll take your money, but we don't know when or if we'll have metal to send you. A solar panel manufacturer in California placed an order for 500,000 ounces at 3:20 a.m. The dealer called back 17 minutes later. We can't fill that. We can get you 50,000 ounces in 3 weeks. A 90% shortfall with a 3-week delay on a commodity that's supposedly trading freely. By any rational standard, this market had already collapsed. At 3:20 a.m. Eastern, the COMEX Shanghai spread crystallized into something traders would study for years. COMEX March futures quoted $80.15. Shanghai physical printed at $88.40. An 8.25 gap between the world's two largest silver trading venues, one that should have triggered instant arbitrage but was instead widening. Under normal mechanics, arbitrage connects these prices. Traders buy cheap in New York, simultaneously sell expensive in Shanghai. The trade is riskless and profitable. But with an $8 spread screaming for arbitrage, nobody was executing. That could only mean one thing. The metal couldn't be moved. COMEX delivery logistics showed strain. Registered inventory, 124.4 million ounces. Delivery notices filed in 24 hours, 36,650 contracts, or 183 million ounces. That's 47% more delivery demand than registered supply. With lease rates spiking to 24%, nobody wanted to lend metal they might not get back. Shanghai's side was simpler. They'd stopped exporting. On November 3, 2025, China imposed export restrictions allowing only state-approved firms with 80-plus ton capacity to ship silver abroad. Chinese industrial buyers, solar manufacturers, electronics producers, EV battery makers were absorbing all available supply domestically. For Western paper traders expecting to arbitrage the gap, this was the nightmare scenario. The physical market had decoupled entirely from the futures complex. By 3:40 a.m. Eastern, the COMEX March contract had entered backwardation, a 2% inverse between spot and futures signaling stress in the physical delivery system. When the curve flips and spot trades above futures, it means the market values immediate delivery more than future promises. In silver, already dealing with 5 consecutive years of supply deficits totaling 800 million ounces, backwardation meant the squeeze was operational. March futures holders who'd sold contracts expecting to buy back cheaper were now trapped. The spot price was rising faster than futures, inverting their profits into mounting losses. With registered inventory at just 124 million ounces against 1.12 billion ounces of paper claims, the pressure to secure physical metal was overriding normal market behavior. Cash settlement pressure was building. When COMEX can't deliver physical silver against a futures contract, it offers cash at current spot. In a backwardated market where spot is surging, forced cash settlement becomes a penalty. You'd contracted to receive silver at 72s. You're being offered cash at $80. The problem? Physical silver is trading at 95. You're being forced to accept cash at a price that's $15 below where you could sell actual metal. CME had raised silver futures margins from $22,000 to $25,000 per contract, a 13.6% increase forcing traders to deposit an additional $675 million in collateral. Leverage positions that were profitable Monday were now underwater. By 4 a.m., forced liquidations had started, traders selling to meet margin calls, which pushed prices higher, triggering more margin calls. At 4 a.m. Eastern, dealer sites displayed a message confirming what traders suspected. The price on screens bore no relationship to actual metal. Out-of-stock alerts covered not just 1-ounce retail products, but wholesale forms, 1,000-ounce bars, industrial grain, even jewelry-grade alloys. An electronics manufacturer in Germany placed an order for 2 million ounces of silver grain at 4:12 a.m. The response: earliest delivery mid-January, subject to availability. That's a 3-week delay on material they'd been receiving next day for 15 years. The manufacturer required 400,000 ounces weekly. A 3-week gap would shut down 2 factories. The few dealers still quoting prices were adding 25-30% premiums over COMEX. 1-ounce bars that showed $80 on futures screens were offered at $105 to $110. That's a $25 to $30 premium on an $80 base. In normal markets, premiums run $2 to $5. Paper and physical had split into separate assets with separate pricing. Global industrial demand was colliding with immovable supply constraints. Solar panel manufacturers required 1.2 billion ounces annually. EV production demanded 200 million. Electronics consumed 300 million. That's 1.7 billion ounces of industrial demand before investment or jewelry. Global mine production, 820 million ounces. Recycling, 180 million. Total supply, 1 billion ounces. The deficit wasn't speculative. It was mathematical. By 4:15 a.m. Eastern, arbitrage had stopped functioning. The Shanghai premium had widened to $9.20 over COMEX, and nobody was executing trades. Professional arbitrageurs had gone silent. The reason became clear. Several major commodity trading houses had failed to deliver against December contracts and were now negotiating cash settlements. They'd sold silver they didn't have. London lease rates had reached 28% annualized by 4:20 a.m. In normal markets, lease rates run 0.3–0.5%. Above 20% signals a delivery crisis. At 28%, bullion banks had stopped lending entirely. The metal in their vaults was too valuable and scarce to risk. Refiners that operated on borrowed metal couldn't source silver to complete orders. The entire fabrication infrastructure was grinding to a halt. The paper-physical disconnect created impossible situations. You'd bought a COMEX March contract at $72 expecting delivery. March futures were now at $81. Physical silver traded at $95. The arbitrage should be automatic, stand for delivery, sell the bars, pocket $14 profit. But COMEX registered inventory had fallen to 121 million ounces. Open delivery requests exceeded that by 40%. Simple math, not everyone standing for delivery would get metal. The futures contract had become a lottery ticket. High-frequency trading algorithms went dark. Arbitrage desks shut down. The digitized, globally integrated silver market was reverting to local cash and carry transactions because the financial infrastructure connecting paper claims to physical metal had fractured. At 4:30 a.m. Eastern, forced settlement crystallized into numbers that couldn't be ignored. COMEX March futures, $81.40. Physical silver on dealer sites, $97.102. That's a $16 to $21 spread. For traders who'd bought futures expecting physical delivery, the math was brutal. You'd purchased a contract for the right to receive silver at $72. The exchange was offering cash at $81.40. Actual silver bars were changing hands at $98. The systemic risk extended beyond precious metals. JP Morgan, HSBC, Deutsche Bank, Scotiabank, and UBS, the 5 banks most exposed to silver shorts, were collectively losing approximately $179 million per dollar increase in silver's price. Silver had moved $9 in 2 hours. That's $1.61 billion in mark-to-market losses before accounting for forced covering. When you're short a commodity that's spiking and illiquid, every attempt to buy back your position pushes the price higher. The delivery calendar made everything worse. January typically saw 5,000, 10,000 contracts settled. This January showed 36,650 delivery notices already filed. That's 7 times normal demand, hitting a system where registered inventory had fallen to 121 million ounces. If even 20% of open interest demanded delivery, COMEX would default. The exchange would either force cash settlements against contracts purchased for physical delivery or fail to settle entirely. Both were now possible within 72 hours. By 4:45 a.m. Eastern, geopolitical pressures that had been building suddenly mattered. China's November 3rd export restrictions weren't just policy, they were economic warfare. On December 28th, Russia announced it would prioritize domestic silver supply for its military-industrial complex and suspend exports indefinitely. 2 of the world's largest silver-producing regions had removed their supply from global markets within 60 days. The strategic calculus was transparent. Silver's industrial applications, solar panels, semiconductors, electric vehicles, military electronics, made it a dual-use commodity with national security implications. The U.S. had designated silver a critical mineral in March 2025. China's response was to lock down domestic supply and force Western manufacturers to compete for dwindling inventories at premium prices. A U.S. defense contractor required 50,000 ounces monthly for radar components and missile guidance systems. Their supplier called at 4:52 a.m. "We can't source the silver. Earliest delivery is March, maybe." That's a defense system production line going dark because the commodity market had fractured. India's position complicated matters further. Indian silver imports typically run 5,000, 7,000 tons annually. In October 2025, India had placed a 1,000-ton order that froze the London market. They were now 2,000 tons behind and expected to request emergency shipments before year-end. But with London vaults down 40% and China restricting exports, where would that metal come from? The geopolitical squeeze operated in parallel with the financial squeeze, amplifying each other. Rising prices made silver more strategic, which encouraged hoarding, which reduced supply, which pushed prices higher. At 5:00 a.m. Eastern, dealer networks confirmed the physical squeeze had moved from imminent to operational. Premiums on physical silver broke $22 over spot, with delivery delays extending to 14 to 16 days. On Monday, premiums were $3 and delivery was 3 to 5 days. In 72 hours, premiums had increased 7x and delivery windows had tripled. Total 1-ounce Silver Eagle inventory across the top 10 U.S. dealers, 847 units as of 5:15 a.m. Not 847,000, 847 individual coins across 10 national dealers servicing 2 million retail customers. Monday average, 127,000 coins. The drawdown was 99.3%. Dealers that remained online had switched to pre-sale models. Take orders now, deliver when metal arrives, no guaranteed timeline. The premium structure had inverted. Larger bars, which normally carried lower premiums due to lower fabrication costs, now commanded higher premiums than small coins. A 1,000-ounce COMEX bar quoted at $94 per ounce. A 1-ounce retail round quoted at $91. The market was paying a premium for deliverable size and form. London dealers reported waiting lists for 1,000-ounce bars extending into February. German refiners were prioritizing industrial contracts over investment demand. A Swiss vault reported a 3-week backlog for allocated storage deliveries. The refiners themselves were trapped. They operated on leased silver, borrowing metal from bullion banks, fabricating it, selling products, then repaying borrowed silver. With lease rates at 28% and bullion banks no longer lending, refiners had lost access to working capital. Several major European mints had suspended production of all but their highest margin products. Every link that failed made the squeeze tighter. At 5:15 a.m. Eastern, COMEX inventory reports printed numbers that made the endgame clear. Total registered silver, 118.7 million ounces, down from 127.6 million at midnight, a 7% decline in 5 hours. Open delivery request for January, 41,200 contracts, or 206 million ounces. The gap, 87.3 million ounces, or 42% of delivery demand that could not be satisfied with registered stocks. The eligible to registered conversion process was breaking down. Converting required the metal owner to re-warrant bars, pay storage fees, and accept delivery obligations. In current conditions, with physical premiums at $22 and lease rates at 28%, keeping silver in eligible status was far more profitable than warranting it into registered. Every rational incentive pushed against conversion. Without conversion, COMEX couldn't meet delivery demands. The spread was expanding, not converging. March futures, 82.10. Shanghai Physical, 91.50, Gap 9.40. Dealer Physical in the U.S., 98.103. You could own paper silver at $82 or physical silver at $100, but they were no longer the same asset. Total COMEX silver open interest, 224,267 contracts, 1.12 billion ounces. Registered inventory, 118.7 million ounces. The ratio, 9.4 to 1 paper claims per ounce of deliverable metal. With backwardation incentivizing physical delivery, an unprecedented percentage of open interest was standing for delivery, and there wasn't enough metal. January delivery period started in 72 hours. COMEX had 3 days to source 87 million ounces of silver and allocate it to delivery queues. Given that global mine production ran 2.2 million ounces per day, there was no physical pathway to close the gap. The mathematics were unforgiving. At 5:30 a.m. Eastern, silver ETFs provided the clearest window into retail panic. SLV, the largest silver ETF, showed its share price tracking COMEX futures at $82.15. Physical silver bid-ask spreads $97.102. The gap, $15.20. ETF holders were realizing they owned a financial instrument that tracked paper futures, not physical metal. The structural flaw in silver ETFs was now obvious. These funds held physical silver in allocated form, theoretically backed 1-to-1. But redemption mechanisms required minimum unit sizes, typically 50,000 shares or about 50,000 ounces. Retail investors couldn't redeem, they could only sell shares on the secondary market, and the market was pricing in redemption failure risk. ETF shares were trading at a 7 to 12% discount to physical spot. PSLV, which held physical in segregated allocated form, was trading at a 4% premium to net asset value, proof that investors trusted its backing. UTI Silver, which had surged 130% during 2025, was now down 8% in pre-market trading as holders dumped shares. The cash settlement cascade was hitting retail investors who'd bought silver through futures or ETFs without understanding they owned derivatives, not metal. When COMEX announced forced cash settlement, retail futures traders would receive $82 for positions worth $98 in physical. That's a 16% haircut enforced by the exchange with no legal recourse. The advice in trading forums was shifting. Sell paper, buy physical. ETFs aren't silver, they're silver exposure. If you can't hold it, you don't own it. When paper and physical diverge by 20% and you're holding paper, you've learned an expensive lesson about counterparty risk. That lesson was being taught to millions of retail investors simultaneously. At 6:00 a.m. Eastern, global supply reports confirmed production couldn't solve this. The Silver Institute had slashed 2026 production estimates by 10%, citing declining ore grades, aging mines, and lack of new discoveries. Global mine production in 2025, 820 million ounces. Projected 2026, 738 million ounces. Industrial demand alone, 1.2 billion ounces annually. The deficit was accelerating. The structural constraint was immovable. Silver mining was 75% byproduct of copper, zinc, and lead production. Silver could double to $160 per ounce and it wouldn't spur meaningful new production because silver wasn't the primary revenue driver for the mines producing it. Price signals couldn't fix the shortage. The timeline to new supply was equally unforgiving. From discovery to production, a silver mine required 8 to 12 years. Even if silver prices incentivized aggressive exploration today, new ounces wouldn't reach the market until 2033, 2037. The current squeeze was happening in 2025-2026. Recycling recovered 180 million ounces annually, mostly from industrial scrap. That number had been flat for years. Even aggressive recycling might recover an additional 30-50 million ounces annually, insufficient against a 200-plus million ounce structural deficit. Above-ground stockpiles were nearly depleted. Total global above-ground silver stocks estimated 1.5 billion ounces. Annual consumption, 1.2 billion ounces. At current draw rates, accessible inventories had 18 to 24 months of cover. China's export restrictions and Russia's supply curtailment had removed 200 million ounces from circulation. India's pending 2,000-ton order would consume another 64 million. The buffers were evaporating faster than new supply could replace them. At 6:15 a.m. Eastern, the spread had reached terminal velocity. COMEX March futures, 83.20, physical silver and dealer quotes, 106. The gap, $22.80, nearly 28% premium of physical over paper. Shanghai physical silver, 95.40. The Shanghai COMEX spread, 12.20, and still nobody was arbitraging it. The mechanism that connected global silver markets had fractured permanently. The inevitability was mathematical. Open interest in COMEX futures, 1.12 billion ounces of paper claims. Registered inventory, 116.2 million ounces. The ratio, 9.6 to 1 paper per ounce of physical. Every delivery request beyond 116 million ounces would be cash settled by force. The exchange could not deliver metal it didn't have. Industrial users were responding with hoarding behavior. Solar manufacturers were panic buying and stockpiling 6 months of supply. EV battery producers were securing multi-year forward contracts at $95–100 per ounce through 2027 because they feared $100 today was cheap compared to $150 in 6 months. This forward buying removed silver from spot markets before it reached them. The feedback loop was operational. Scarcity drove hoarding. Hoarding amplified scarcity, which justified more hoarding. Lease rates at 30% signaled that nobody with physical silver would lend it. Backwardation deepening to 3.2% proved the market valued immediate possession over future delivery. The price explosion was no longer speculative, it was structural and inevitable. With production unable to increase, demand accelerating, inventories depleted, and nation-states hoarding supply, there was no equilibrium mechanism. Silver would have to rise until demand was destroyed, until solar panel production became uneconomical, until electronics manufacturers substituted copper, until industrial users couldn't justify the cost. That price point sat somewhere between $120 and $150 per ounce. The paper market was going to zero by force. The physical price had decoupled permanently. The spread that opened at 8:35 between COMEX futures and Shanghai physical at 2:47 a.m. had widened to $12.20 by 6:15 a.m. The dealer premium that started at $15 had blown out to $22.80. Registered COMEX inventory that measured 127.6 million ounces at midnight had collapsed to 116.2 million ounces. The paper-to-physical ratio that ran 8:1 in normal markets had stretched to 9.6:1. Every metric that measured market stress had moved in one direction, toward dislocation, toward breakdown, toward a future where paper promises and physical reality existed in separate markets with separate prices. The arbitrage mechanism that was supposed to connect them had stopped functioning, and in a market where 1.12 billion ounces of paper claims faced 116 million ounces of deliverable metal, the math had become inescapable. This wasn't a correction that would resolve with time. This was the repricing of silver from a paper-traded commodity to a physically constrained strategic resource. The system that was supposed to deliver metal couldn't. The squeeze wasn't coming. It had already arrived.